Look at the closing prices. Have you ever seen anything so steady?
Oh, wow. Look at that.
Isn't that amazing?
I
Yeah.
never noticed that. Look at
And
that. I mean,
even
boom, boom,
now, you
boom.
got an up month. Okay. Now punch up a silver chart at the same time. While you've got that sideways action there, silver
Okay.
monthly.
This
Okay.
is Silver
Since
Monthly.
April, go back to April,
April
which is that big down. Okay. That
is,
month
yeah,
right there.
yeah.
You went from that monthly close up to where you are now, and you've still got an up month by about 70 cents right now. While gold has gone sideways, silver's gained 10% or more.
Welcome to In It to Win It. This is Steve Barton, and thank you for tuning in. We are back with a fan favorite, Michael Oliver of Momentum Structural Analysis. Michael, thank you for coming back on the show.
Good to be back.
Yes, sir. It's great to have you. Thank you. Let's start out like we always do. And what is your macro view of the world economy and financial markets today?
Um, we still think the US stock market, which is the bubble market of the world, by the way, is topping out. We think we issued a sell, get out of this market in January, like the first week for the S&P 500. And it took it a while, but it finally imploded down to a what we call a bounce point. In other words, when the break started and really got going in late February, March, April, uh, we thought it would bounce from 4,800 level S&P after having been over 6,000. It did. It bounced. I think the low was 48.35. And there were a couple technical reasons for that. We didn't predict that it would make a new high after that bounce, but it did. And fine and dandy, because momentum laughed at that new high, has laughed at it. Long-term momentum, if you plotted a momentum chart of the S&P as opposed to looking at just the price chart, which everybody does, you would see a different picture. You would see a broken picture, fully broken in that early year break. And the rally back up to a new price high is up to underneath that which it broke on momentum. So on a momentum chart, you'd be seeing an uptrend structure being bumped from the underside. So
Kind of
momentum
like
is saying
that.
something different than price is saying. That we do not trust price here. We think once you roll over, and we're toying with some numbers right now, actually, on certain key indexes and especially key symbols like Microsoft and NVIDIA, that just might spark the kind of rollover that gets you back below the prior distribution highs. What are distribution highs? Well, you'll see in late 2024, early 2025 on the S&P, there was a zone of resistance. In fact, when you came back up to it in May, you came up near that high and you found sellers again there. Okay. Distribution, meaning somebody saying, get me out, get me out, get me out. You broke through it. Fine. Question is it a valid breakout or is it a a bull trap where you suck in new longs at very high prices and you trap them? If you break down and you especially get back below those price levels that you saw around 6,100 back in early this year, and Nasdaq has some comparable charts, Nasdaq 100 comparable highs, then what it says by price is that, hey, that launch is failing. The rocket is coming back to the launch pad and going to explode. Okay. Uh, can you punch up a weekly chart of this instead of the daily, for example?
Weekly, boom. Okay.
Yeah, there's a widening, what's called a broadening top here. In other words, the recent high, call it number 5,
Okay.
and then you made a low back in April that took out the prior low, which was back in last summer. The low last summer was higher than no, a little higher, 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 higher. That
Oh,
green,
right here.
no, further, further, further. That one, yeah. Okay, there's a low that's prominent. Okay, now go to the high that preceded that low.
Right here.
That one, now mark that spot, okay? And then mark the spot in early this year, just above 6,100.
Earlier this
Yeah,
year,
yeah,
just
right
above, right in here.
before the break, 6,100, before we topped out. We topped out at 6,100. No, to the
Oh,
left.
oh, right here.
Yeah, right
Sorry.
there. There you go.
Yeah.
Now, okay. Now you've marked 5, 4, 3, 2, 1. It's a broadening pattern of action.
Okay.
Most people are used to looking for triangles where it narrows,
Yeah.
the highs get lower and the lows get higher, and you break out. Back in 1958, two guys named Edwards and McGee wrote a book called Technical Analysis of Stock Trends. It was the textbook of price chart technical analysis for years and years. Probably still is. In 1975, when I joined Hutton in my early 20s, I bought the copy of that book from a local financial bookstore. It's 400 pages thick, very fine print, and they have tons of chart patterns in there of bottoming patterns, topping patterns, and so forth. This is a pattern that very few people remember or like to talk about. It's a topping pattern, and it's an irregular one. It's the 5-4-3. It's an expanding triangle going the other way.
Yeah, kind of like a megaphone, right?
Yeah, a megaphone, but the opposite way. Instead of narrowing, it widens. Well, what that indicates is a market that has lost its sense of direction. Makes a higher high, doesn't sustain, makes a lower low, doesn't sustain. It's like a drunk, okay? And that fifth high is critical.
Okay.
Because if you fail from that high, by our assessment of this simple tool created by Edwards and McGee, you don't want to get back below that second peak there, meaning the high early this year. If you do, it suggests to us, it argues to us, momentum already argues to us that this is likely to happen. This whole game is over. You've witnessed a broadening top spanning a year. Summer last year, summer of this year. It's about 13 months wide. That's it, okay? So even the price chart offers to us something to watch. Momentum already tells us don't trust it. And you have a similar pattern, by the way, on Nasdaq 100. So it's not just the S&P.
Yeah.
Now, but also when you go inside the market and you really scroll around and look at different sectors, some key stocks, even the Mag 7, there's really only Mag 3 anymore. Meta, Microsoft, and NVIDIA also made new highs on this rally, but the Mag 7 as a group did not.
Yeah.
So the leadership narrowed. Okay. That's what's happening within the market as well. There are plenty of sectors that did not make new highs. In fact, didn't even get close to the early year highs. So the market really doesn't have the strength that you think it has. It's narrowed. So from that perspective as well, something we don't specialize in, but a lot of people do look at that, the advanced decline line, et cetera, et cetera. So I think we're looking at a broadening top pattern here. And I think we'll enter a major bear market on the other side of this. I'm not going to tell you how deep or how long, but usually the bear markets last a couple of years and they're pretty savage. And the leadership on the upside will likely be the leadership on the downside. Now, what does that mean? Well, it probably means that AI is going to lead the way down. Now, if you look at just what's happening today as we're doing this interview, the S&P last I saw was down like 0.3%, whereas NVIDIA is down 2%, Microsoft's down 1.5%, et cetera, et cetera. Anyway, I think we're looking at a major market top in the U.S. stock market bubble. And this is true in some other indexes as well. But primarily in the U.S. market is the most exaggerated bubble we've ever had. And it stands out compared to other stock markets in the world as well in terms of, excessive upside over a duration of time that is exceptional as well. Anyway, I think we're looking at a major topping pattern. And I think it'll have wave effects in other markets, especially the monetary metals, to the upside.
Okay, so what you're seeing is basically kind of a broadening backwards triangle pattern here that's
right.
Probably likely to reverse. And if you look at this momentum, this is a price chart, but if you look at your momentum charts, the chart kind of more goes like that.
Hey, you nailed it.
In other words, this is a lower high, not actually a higher high.
Yeah,
right?
That's correct. So momentum is telling us don't trust price.
Yeah.
And frankly, over the decades, we trust momentum. That's why we call ourselves momentum structural analysis.
Yeah. Okay. Interesting. And if that's right, then you're probably, like all bubbles, the ones that ran the highest and the furthest and the fastest are going to be the ones that return and give those gains back the quickest as well. And they'll be leading the downside.
Correct. I mean, what does that say? remember the dot-com high. Okay, when the S&P peaked in 2000, it dropped a little bit more than 50% by 2002. Nasdaq 100, which had been a leader on the upside because it represented the internet, the bump, the dot-com, dropped 82%. Okay, did that mean that all we heard about internet changing our lives was wrong? No, of course not. In fact, they were more correct than they thought fundamentally. The problem was they got ahead of themselves and they got flushed. And when markets get excessive one way, they tend to go ridiculously excessive the other. You know, they're irrational one way, they're irrational the other, and they cleanse themselves. The problem this time is the bubble is vastly bigger than any other bubble we've seen, both in duration of time, upside, number of years, 2009 to 2025. Okay. The percent gain, the multiple gain, S&P gone up 9, 10-fold, Nasdaq up 19-fold. There's no bull market in history that compares to that. And you could say, well, that's because the economy's been strong. Okay, fine. But look at an M2 chart and look at a Fed funds rate chart, and you'll understand, what was injected into the market to give it its vigor. Okay.
Yeah.
It was drug induced. And anyway, that's the situation we're facing, and it will create real world consequences, which the central banks, not just ours, but others, will panic over. And when they go into panic mode, that just means the monetary excess that is ongoing will get even more so, which will benefit what? Gold and related.
Yeah. Okay. Okay. I'm pulling up a chart right now of. Can I pull it up? Oh, I'll do it. I'll do it on the next one. What? Okay. So S&P 500. What are your macro thoughts on the dollar, on the DXY, as it's compared to
Yeah, the
other
dollar
currencies?
had been. If you punch up a chart, you'll see that, punch up a weekly if you can, dollar index.
Okay. And weekly dollar.
Yeah, now,
There we
yeah,
go.
okay, there you go. Now, on price, you're trying to hold a channel bottom, okay, as
Yeah.
you projected it there. However, when we run annual momentum, that means when we oscillate the price action versus a 3-year average or a 10-year average even, we've blown that channel. It's
Okay.
gone. So momentum has blown what price is still trying to grope and hold for the last 4 or 5 months in the dollar. Back at 104, which is about midway in that last drop, about 104 price level, right about there, we turned major bearish because it broke the 3-year average annual momentum structure. Not the price structure, but you broke momentum. We're now at 98. Okay. No big collapse, but a good drop. We've wasted 4 to 5 months now, April, May, June, July. Hey, by the way, it tried to stop going down the same time the stock market tried to stop going down, April. Okay. April, May, June, July, now in August, of nothing but sideways turbulence. 2, 3, 4 point rallies, failure. 2, 3, 4 point rallies, failure. It
Yeah.
can't seem to get off the ground. All
Yeah.
it's done is waste time holding that trend line that you plotted, but
Yeah.
also below the floor of the prior couple years.
Yeah.
I think the dollar index is headed a lot lower.
Okay.
I think the next phase is likely to start within a month or so, where you start to go down and break 96, 95, et cetera. And that's when the public breaks that price channel. And analysts, price chart analysts, then say, oh, this doesn't look good.
Yeah.
We already declare via momentum, it doesn't look good. We're headed into a major bear trend. That could become a factor impacting other markets, especially foreign investors who buy US government bonds in dollars, or foreign investors who buy into the US stock market in dollars. They get whacked not only by a dropping stock market, but by a dropping dollar. And it could also be some wind at the back of gold, although the dollar index and gold correlation is not a good one, by the way.
Dollar index in gold correlation.
Yeah, in other words, if you use the dollar index up or down to decide whether to buy gold, back in December of 2015, when gold made its low, The dollar index is where it is right now, 98 area. Right.
Oh, okay. Yeah, yeah, yeah.
Yeah. In other
Yeah,
words,
around here.
you're sideways from 10 years ago.
Yeah.
Gold has tripled.
Yeah.
Okay. So, in other words, while the dollar effectively has gone up and down, but now sideways for a decade, gold has tripled. So it was not a good indication whether to buy or not buy gold. However, if you precipitate this to the downside now and you get a whoosh effect, and I think you could challenge those 2008 lows, by the way, maybe take them out,
Yeah. Down over
that
here.
will probably help cause some further input into gold, although it's not one of these things that is a direct correlation, inverse correlation.
Okay. Okay. What do you see happening with that? What do you see happening? This is the 10-year Treasury yield.
Yeah, okay. But we
What?
watch 30-year bonds, which is effectively the same thing. So you're looking at yields, we look at price.
Okay.
You'd flip that upside down and you'd see a 30-year T-bond. And what you go back to the late 2022, which is when you got up to that first surge there, that
Mm-hmm.
up there at the red line, the first time you hit that 4.30 level. No, further up there, higher,
Oh,
higher, right there. That's
right
late
there.
2022. You can draw sideways. So yields have not yielded
Yeah.
since they've choked. So high yields have remained, and that is a choking factor for people who have long-term debt, especially long-term debt that is coming due this year or next year. Commercial real estate would be a conspicuous area to watch in that regard. They're not getting any relief. No, it's not going higher, although it's threatening to now. Now, when we invert this and we look at T-bond futures price, we see a basing pattern. But the problem is the basing pattern is now extended too long. It's been too many months now. It took 3 years of trying to put in a bottom, or in this case, trying to top the yields. You should have already, if you're going to drop the yields, you probably should have already done it, and it hasn't done it.
Yeah.
So that means that T-bonds, as an alternative to the stock market, if you're an asset manager and 60/40 principal stocks, bonds aren't offering an alternative. They're still just choking at a high yield. And the only thing that's been offering an alternative to stocks is gold. For the last 10 years, last 5 years, last 3 years, it beats the S&P. Bonds have not served that function. And if they don't soon start to break in yields, instead have another spike up, I think that could create a mini panic that impacts the stock market as well. Not just the dollar situation could impact the market as it accelerates on the downside, but T-bonds, if they don't provide relief soon, instead they blow out through that top of that zone of yield,
Yeah.
then that's another, ambush for the stock market. And this is a market that's bigger than the stock market, So these are areas to watch if you're in the stock market. Why is we not getting relief in the long-term end of the market? Fed doesn't control this.
Yeah. Yep. They control the short term, not the long term.
Yep.
Okay, so DXY down, bonds could blow up. Let's move on to gold. So macro thoughts on gold here. This is the futures price. I can pull up spot.
That's fine. That's fine.
Okay.
Go back there and where you got your line first drawn. See that cluster of sideways ink after that surge?
Yeah.
You surge up. Look at the number of, what is this, weeks or months?
This is a weekly chart.
Weeks. These are weeks. Look at the sideways action there. Gold never tops with comatose sideways action. Okay, that's an example of it. Another one would be the next congestion zone you see there, where you tried to break it, came back up, tried to break it, came back. Gold doesn't top that way.
Yeah.
Now look at this. We're entering 5 months now.
Yeah.
Of absolute comatose sideways. Punch up a monthly chart. Look at the closing prices.
Yeah.
Have you ever seen anything so steady?
Oh, wow. Look at that.
Isn't that amazing?
I never noticed that. Look at that.
Even now,
boom,
you
boom.
got an up month. Okay. Now, punch up a silver chart at the same time. While you've got that sideways action there, silver
Okay.
monthly.
This
Okay,
is silver
since
monthly.
April, go back to April,
April
which is that big down. Okay, that
is,
month
yeah,
right there.
yeah.
You went from that monthly close up to where you are now, and you've still got an up month by about 70 cents right now.
Huh.
While gold has gone sideways, silver's gained 10% or more.
Yeah.
Yeah. So again, gold, the mama market in the monetary metals, does not top going sideways. If you think it's going to top here, uh, ask yourself the question, is that the way it ever behaves? It doesn't. 2011 top, 2015 low, 1980 peak. They're all, you never came back to the high.
Yeah. Yeah. You had to
You
spike up
never,
and then just kind
yeah,
of a blah.
you couldn't even get back to 1800 again in those two rallies that followed that 1900 peak.
Yeah.
You couldn't even reach 1800 again.
Yeah.
We keep coming back to the same high.
Yeah.
Okay, it ain't a top.
Okay.
Sorry.
Okay.
Okay.
Yeah. I had a friend asking me about, anyways, part of his retirement account or where to put it, and he was thinking about bonds. And I said, you were going to get smoked by inflation. You're probably better off just buying a physical gold fund than you are a
Gold is
bond.
to me gold, raw gold, unleveraged gold is just holding cash.
Yeah,
It's like putting it in the bank. Uh, uh, Gold holds its value over investment lifetime after investment lifetime in terms of the degradation of the money unit. Money supply doubles almost, goes up about 90% every decade. Population doesn't, by the way, so there's no excuse. In the recent decades, even more.
yeah,
Uh, Gold, go back 20 years, 25 years, quarter of a century, and randomly in mid 2000, 25 years ago, summer 2000, S&P's up 3.5 fold. Gold's up 11 fold. Okay. So if you're just a dumb, unleveraged investor and you bought the S&P, you're smug and smiling, right? But you haven't been keeping up with the growth in the money supply,
yeah,
the degradation in the real value of what you've got. Gold has held its value. It
yeah,
always does. Now, it may ebb and flow, but ultimately, and even when you go back 10 years, 5 years, 3 years, and plot where gold was then compared to S&P,
yeah,
gold's gaining the whole time.
yeah.
Okay.
Yep. Okay. All right. I wrote, maybe pull up the XAU divided by gold chart, which is here. Okay, we
Aha.
talked about this chart the last time you
Oh.
were on the show, and I drew these white lines, I think while we were on the air. So this is basically gold miners divided by the price of gold.
Yeah, gold and silver, by the way.
Oh,
XAU,
gold and
quite
silver.
a few silver miners. In
Okay.
fact, it's called the gold and silver index. Uh, if you look back in the 80s, 90s, and into 2000, it lived in a range that you could divide about 25% was about the level. In other words, its price was about 25% of the price of an ounce of gold. Okay. And the lows were about 17 and a half, and the highs were well over 30. Okay. So that
Yeah.
was its living zone for multiple decades.
Yeah.
Then came the bear market all the way down to the 2015 low. It got down to 4%.
Yeah.
I mean, it got wiped out. Okay, the miners did. Okay. But since then, we're actually higher than we were 10 years ago on that spread. It was 4%. We're now 6.5 or so. Okay.
Yeah.
So that's a 50% gain, by the way. It's like buying a stock at 4 and it's now 6.5. Okay. So don't chuckle. It's not just 2.5%. It's a substantial gain.
Yeah.
We've broken out in the last several months above a downtrend that goes back to the 2020 highs and above recent highs as well. So, if you treat that as a price chart
Yeah.
and draw a downtrend or horizontal, you've broken out above that.
Yeah.
Remaining structure is up there at that 8% plus level, which you probed back in 2007, 16. You probed in 2021. And you plot only monthly closes, you'll see if you get a monthly close up there well above 8%, you're breaking out. Now scan back to the long-term chart you had a minute ago. Okay, when you look at this chart and you say, okay, it's a price chart, where's next resistance? Okay, you break out of the base, where's next resistance? 17.5%.
Yeah.
Okay,
Yeah.
you'll see the multiple lows there, and then the rally high in 2009 that reached up to 17.5% and failed there.
Yeah.
It has marked the spot. So once you unleash out of this base, super cheap gold miners and silver miners versus the monetary metal itself. If they say, okay, it's our turn to shine, and we think that shift is already underway, that's a tripling in the value of the gold miners relative to gold, even just to get to the bottom side of the prior multi-decade normal zone. Tripling.
Yeah.
So no matter what gold does in the next year or two, the miners, if you continue this rally and you get up above that 8%, meaning go another 1.5% from where you
Yeah.
are now, watch out. You could launch this beast. And there's no resistance until you get up to that 17 plus level.
Yeah, there's very little there's a boatload of resistance here at 17 and a half and
Yeah,
probably
yeah.
even more here at 25,
Yeah,
but
but forget
it's
it.
pretty much just a clear shot.
Even if you just go to 17 and a half, you're retired.
Yeah, exactly.
Okay. You don't care.
Yeah.
So don't worry about it. The issue is already you're well off the lows we've seen in the last 10 years. So miners are actually, though it doesn't look like it, are gained more since their bear low in 15 than gold has. Even though when you look at their price chart, they're not above, which you don't have here, they're not above their 2011 highs. In this case, anyway, you get the point.
Yeah.
We're focused now on silver, and gold and silver miners as outperformers to gold going forward, likely dramatically.
Okay.
And personally, that's where I'm fully invested, is in the silver miners and gold miners. And when I ever want to move something to cash, I do, but it's called bullion. Okay.
Yeah. Yeah.
Bullion ETFs. Okay.
Yeah. Okay. Okay. Something like PHYS.
Yeah, something. Yeah, that's right. Yeah.
Okay. Okay. That hit that one. Okay. We got a listener question here from Ralph. Ralph, thank you for the question. He says, how does one navigate investing in gold and silver equities when the broad equities markets begin its decline? Won't a broad market downturn bring all equities down?
No, it won't. Yes, there are times in the past when you get a crash event in the stock market, which is rare, by the way, in bear markets in the U.S. stock market. 1929 began with one and then rallied halfway back to its high. And then the real bear market started from 1930 to 1932. Arduous arm wrestling bear market, no crash. Okay. Look at the .com and the S&P to 2002. There was no crash. It got cut in half with no crash. In the 2007 to 2009 bear market, S&P got cut in half. There was a crash, but it occurred a full year after the bull market peak. Price had already imploded significantly in the S&P before you ever got what you could call a crash event, which is in October of 2008, half a dozen months before the final low, but a full year off the high. During that time, gold and silver miners ramped. Now, yes, when that crash did occur, and I'm not forecasting a stock market crash, by the way, I'm forecasting a bear market. Doesn't have to crash. In fact, that's sort of a rare event, as I've said. The gold and silver, gold has been the only place to be in all the bear markets in U.S. history. You go back to 29 to 32 and see what went up. Gold was illegal, but home stake mining wasn't. It went up like 1,000% during the entire bear market. Go to 2000 to 2002. Look what gold did during that time. Advanced the entire time and beyond. 2007 top in the S&P to 2009. Gold advanced except for a very bad month in September, October of 2008, where gold did join with stocks for that brief period, but then immediately went back to its highs within a handful of months, whereas the S&P continued down until March of 2009. So to look for examples of coincident negative behavior is rare. The primary trend of gold during stock bear markets is it benefits from the exit of flow of cash out of the stock market. It is an alternative. And this time, I think because of the exaggerated nature of certain things, technicals and fundamentals, this time the gold bull market could be totally different than any other bull market we've seen. Meaning when it goes up there, it doesn't come back down. It becomes institutionalized here, there, and pretty soon everywhere around the globe as finally we go out of fiat money into something that's real money. The decision is made. We'll probably be the last to do that. Okay. But a lot of countries are already, on an intellectual direction that way.
Okay, so what I hear you saying is there may be a little blip on the radar, but don't expect that if the S&P has a pretty brutal correction that gold.
Yeah, in fact, right now I'm looking for the S&P breakage. Not a crash. I don't think that's what you're likely to see. To help spark a more rapid flow of money into the gold and gold miners. In fact, if you'll look at the gold miners, like what's been going on here, Newmont Mining, which is not an outperformer at the present.
Newmont, okay.
Yeah, Newmont is a good example. Go back many more decades if you can, 2007 or 8.
Okay, Newmont, and boom. Okay, there we go.
Yeah, there you go. Look at its prior peaks. Now look where it is now.
Yeah.
I mean, you're challenging its all-time highs. There were some spikes up there.
Yeah.
They were very brief. You can see that like 1 month, that kind of thing. We just Newmont, we gave a buy signal in I think it was April of 2024 when we were coming up through $40, 30.
Yeah, that was amazing,
30s,
wasn't it?
and it had a sharp pullback after that, but it didn't change the momentum trend. And now you got through, there was a horizontal level of price resistance where they wouldn't let it close over $54 for a couple of years because prior monthly close lows had been $54. When we burst through that, we ran up to 70 in a heartbeat.
Yeah.
So even what's going on here? I mean, gold's been dead sideways for the last 4 or 5 months, yet Newmont has gone from the $40 range up to 70. What it indicates to us is there's some big asset managers out there who are getting doubtful of the stock market. As I said, the distribution highs early this year. Somebody said, get me out of this beast, okay? And they still have that doubt. There's various fundamentals people look at, earnings ratios and all that stuff. But if they just looked at momentum, they would have further justification for exiting that market while it's strong instead of when it's weak. And where do they go? Well, they can't go into T-bonds. Those haven't been working out.
Yeah.
I think they've been buying blue chip gold miners, and the standout is Newmont. Now, I can't prove that. I just make that point that while gold has gone dead sideways, Newmont's exploded. It's up like 80% on the year or something.
Yeah.
Stock market's up 9% on the year right now. Okay, where it closed last year. What's going on there? Well, I think there's a money flow, and it's not just Newmont, by the way. It's GDX as well. It's scooted big time. And it's also the silver miners. If you could punch up SIL, for example.
SIL?
Yeah. This is the silver mining, Global X silver mining ETF. Go back to 2011.
2011.
Okay. There you go.
There.
It was up at $90. Okay. Yeah. Look at that price base. Now, momentum told us months and months ago we're going to break through that base. Right now, you're credibly out above that base, and particularly if you measure it via peak monthly closes, you're well out above peak monthly closes. So after 3 prior rallies that reached up to that 50 level, you can see there was 2 there, and there's 1 over there. Right after you broke down, there was a rally that came back up there as well. You've just now broken out of a massive 10-year wide price base.
Shoot.
Why should it peak now? Okay.
Yeah.
People are, it's got to, they're looking at something that's weekly, like the last year or 2 of action. When you stand back and look at what this has done, it's just awoken in terms of price factors. We project this is going to challenge and take out the 2011 highs, quite possibly by the end of this year. Now, maybe it'll pause on the other side of that. But right now, it's 50 something. It could go almost double just to get to those highs. And if you measure the dimension of that base and swing it up, it says that, the thickness of the base, high to low, high to low, high to low, just add it to the base and it says I'm going up to $90 again.
Okay.
Okay. Just orthodox price analysis. So this is what something's going on here. And gold didn't cause this move the last 4 months. Gold's gone sideways for 5 months. Look what's happened in the last 5 bars there.
Yeah. Yeah.
Huge move,
Yeah.
percent-wise.
Huh. Okay.
Yeah.
Let's see. Sticking on with silver equities, Darren wants to know. He says, "Hey guys, do you anticipate a moonshot with any degree of certainty in silver equities?" I guess we just kind of covered that.
Yeah, I do.
Yeah.
Moonshot being you're not going to crawl your way back to that high.
Yeah.
Okay. And just getting there is a moonshot, percent-wise. Okay.
Yeah. Okay. There you go, Darren. Derek, I once heard you say your personal assets are majority silver equities. Is this still the case?
Yes. Silver bullion, double silver bullion ETFs, silver miners, SIL. I also own the GDX and double GDX ETF. And GDX has about 6 or 7 big silver miners in it, by the way. So it's called the Gold Miners ETF, but you name a big silver miner and it's in there. And there's at least a half a dozen of them.
Yeah, Pan American.
Yeah, and Core and
Core.
So there's a lot of them in there.
Wheaton.
Yeah.
Yeah.
So anyway, in fact, even though I'm bearish on the stock market, I'm not going to go short the stock market. Why? Because I'm going to make more percent gain be long silver than I am short the stock market.
Yeah.
Percent gain. Okay.
Yeah. Okay. So you even like the double GDX, the
Nugget, it's called. It's a double ETF of GDX, and there's a silver bullion double ETF, AGQ, I think it's called. Anyway, I'm focused entirely on that segment of the monetary metals, not gold. I do have some gold bullion ETFs, but my main focus is on the silver and the mining assets.
Yeah. Okay. Okay. There you go, Derek. Macro thoughts on copper. Let me pull up the copper chart here and let us know what you think. There we go. Okay. Copper futures. This let me pull up the weekly here. So we had the Trump tariffs, and then he walked it back in a day.
Yeah. These are headline news chasers. Okay.
Yeah.
Don't chase headlines. Listen, copper is an international essential material. It's produced globally, consumed globally. What one country does, even the US, in terms of tariff or not tariff, okay, doesn't change the long-term fundamentals that drive this metal higher. Okay. Now, by the way, can you punch up COPX, which is the copper miner? Look at that drop. Okay. Now, when you go to COPX, you'll see that it had a drop. This is weekly again. Okay.
This is weekly. Yeah.
Yeah. It's back to a new high for the move. Copper,
yeah. Yeah.
The miners say, hey, this isn't real. Don't trust what the specs did. They panicked on the news. Don't buy or sell that type of news.
Yeah. So the yellow here is the spot price of copper.
Yeah.
And the miners basically didn't
they
even
had
care.
a bad week there, but then look where they are now. They're back up pushing their highs. So
yeah,
it's either the miners are totally stupid or they know what I just said, which is to say, ultimately this market's not driven. Now, I will tell you this. I don't particularly want to see copper, which is now in the 450 zone, up and down quietly, close out a month credibly back below 4.
Okay.
I don't think that's going to happen. But right now, that would be the only point where I say, okay, now I'm a bit concerned. Monthly close, especially. And it's not a price-based thing. It's a momentum-based thing. I don't want to see it get back, but below that range of prices.
Right.
Price would look bad there, and also annual momentum would be cracking a structure. So
okay,
we'll see if it holds here. I suspect it will.
So right around, right where that green line is. We don't want to see it close.
Get credibly below 4 in a monthly close. That would concern me. But otherwise, no. No.
Okay. I really thought this sell-off here would create some amazing buy opportunities in COPX.
Well, somebody's bought it for a month now.
Yeah.
It's now 4 weeks, right? Yeah, 4 weeks since that break.
Yeah.
Uh, so somebody's been accumulating it
Yeah.
and not down at where the price lows were either. So
Yeah.
they didn't wait for it to get back to the low fours. They bought it in the mid fours. So anyway, yeah, I think copper is now another factor for copper. Copper doesn't tend to move with gold. Sometimes it does, sometimes it doesn't. It tends to move more in major sync with the Bloomberg Commodity Index. So when copper started to launch here, months ago, the Bloomberg Commodity Index didn't. It's been dead comatose steady for 2 to 3 years now, either side of 100. But our work on yeah, look at that. Now, the Bloomberg made its peak several weeks after the war began, the Ukraine-Russia war.
Hmm.
It peaked in March. The Russia-Ukraine war began in February 22nd.
Hmm.
So well, that's June there. Okay, but there was the high monthly close, I think, was in March. Anyway,
Yeah, March
it
right there.
peaked right after the war began. Look what happened prior to the war even starting. We got bullish back in late 2020
Oh yeah.
at a price of about 70. It went to 140 before the war even began. Same with crude oil, same with the complex itself, the Bloomberg, same with copper. Then you've had a pullback. Now, copper's tried to come up out of this zone. It got up over 5 and
Yeah.
got whacked back down. But the Bloomberg hasn't done that yet. Now, you'll notice there's a horizontal across all the highs on Bloomberg there going back to late 2023.
Okay,
It's
so like
about, 107, 108 level.
kind of like
You
that.
close a month out during this year over 106.52, you're gone.
Okay.
Okay. You've probed up there intra-month, but you've never closed a month out above it.
Yeah.
So right now we're just below 100. You go up about 6% from here, go back to that zone again, you're going through this time. And I strongly suspect copper will then be free to engage. It won't just be money flowing into copper, it'll be into the entire commodity complex. Crude oil, I think, will also be a participant. Right now, it doesn't look like it will be, but I think it will.
Okay. Let's see. We hit that. You brought it up, so let's go here real
Just hit
quick.
crude, yeah.
Yeah. Let's look at crude. What are you thinking on crude
Yeah,
here?
I think that it's the action back in, you can even go further back and yeah, you'll see, look at all the lows that occurred there in the 60 zone.
Yeah.
Okay. Yeah, look at all those lows. You broke through it late last year, early this year.
Hmm.
Okay. And then you zoomed back above it like, oh, breakout was fake out.
Yeah.
Okay. Okay. Now you're back pushing that level.
Yeah.
We have a long-term momentum breakout level. Now, those recent highs are up near 80, you'll see. The
Yeah.
recent rally highs. Okay. Just like the other highs. Somebody sold the other highs. Okay, fine. They're playing chart games. You get back up and close a month at 70, which isn't even taking out that recent high that got up well over 70.
Yeah.
Close a month out at 70 during this quarter, you're gone.
Okay.
Next quarter, it's going to be about 68, a level
Oh.
that doesn't mean too much on a price chart. But
Yeah.
I will blow a momentum structure that goes back several years at that point. So oil will then wake up and suddenly be a leader on the upside again, and a major component to the Bloomberg, of course. Now that's well before price breaks out over any of those highs. Quarterly momentum says 70 this quarter, around 68 next quarter. Close a month, you're out of here. Now I don't know what's going to cause that. I suspect it's strongly, primarily, simply money flow out of a very underpriced global asset category, based commodities, including oil, and out of bloated assets like the US stock market.
Yeah. Okay. Okay. That kind of goes in line with the fundamental argument Rick has been saying is he's like $60 is kind of break even worldwide. He's like, no one wants to drill for more oil to break even.
Yeah, no, it's no, I quite agree. And I think it's bigger than just oil related news. Like, it wouldn't shock me if peace comes to to Ukraine that oil goes up. Because what happened when the war started? You would think, oh, that's bullish for oil, right? No, you should have shorted it about 3 weeks later. You would have nailed the top. Okay. Anyway, That was when it was $130, by the way, but not yeah. And when the war started, basically it said get out of crude oil. You
Yeah,
think just
yeah,
the opposite. Buy the war. No. Now it's time to buy the peace, I think, if that happens. So
yeah,
anyway, that's an irrelevant issue, really, I think, because globally, again, we produce so much, we consume so much, regardless of whether there's a war going on here or there, it's still a global issue of supply demand.
yeah, yeah.
And
I
there's
just toured. Oh, go ahead.
yeah, go ahead. You just toured what?
Oh, I just toured a an oil site yesterday, and the guy was telling us he's basically telling us his frustration about how politics is holding drilling back, and he's like, if this is really what people want, then they're going to have $8 a gallon of gas, and I just lit up
No, yeah,
because of my
yeah,
oil investments.
yeah. You talk about there's all kinds of upset factors that could come into play, not just market factors, because when the market breaks, stock market, everybody with a 401k, the only thing they're smiling about is their 401k, right? If all of a sudden you take 20% off that over a span of 3 or 4 months, 6 months, and then 30%, then suddenly they don't have anything to smile about. And if you factor in such things as, hey, he said he was going to get my price per gallon gasoline down. If all of a sudden it jumps 50%, crude oil goes from 60 to 90, let's say, which isn't even halfway back to the $130 high.
Yeah,
And all of a sudden your gasoline price goes up. You're going to say, hey, nothing's working out. Everything we were told isn't happening. And suddenly you have an emotional upset factor,
yeah.
which will come into play. It almost always does in stock bear markets. Something happens off to the side that people weren't expecting, and desperation, emotion comes into play. Yeah.
Yeah, yeah. All righty. What do we got? Emerging markets.
Oh yeah.
Mr. King wants to know, please give your view on emerging markets and
Mhm.
especially India. So I'll share
Okay.
my.
We put out a report on China and India routinely, fairly routinely, especially China. China's making, it's quite strong lately. But if you look back to the 2009 low in China, now China constitutes 30%, for example, of EEM.
Okay, here's EEM.
Yeah,
You want me to pull up China or is this one okay?
no, that's fine. But
Okay.
China also, if you measure back to the 2009 low on the Shanghai composite, for example, it's only a bit more than double where it was then.
Hmm.
Okay. Now, emerging markets have been Deadsville for what's that? Uh,
Oh, this
20
is back
years.
in 08,
Well,
09.
you
Yeah.
go back here to the 2006-07 period. I mean, it's dead for decades.
Yeah.
Nothing going on. So there's no bubble here. This is a market that says, hey, this is where I am.
Yeah.
And it just can't seem to get going. It is not a bubble market. China is definitely not a bubble market. And China's quite strong now. Now you could say, well, it's because US market's up. Well, but China isn't double. It's a bit more than double where it was in 2009, whereas we're 9, 10-fold on the S&P. Okay. Technically, it does not look the same on momentum as the US market. China doesn't, and emerging markets don't. Even looking at the price chart here, you don't have a market that doesn't know it's happy here. Okay. It's not excessive. We made a bet, and I'm not going to do it personally because, again, I'm emphasis in silver and the gold silver miners. But if you went out right now and put $500,000 into emerging markets, now there's some exceptions within that we don't particularly like. India would be one. We'll get to that in a minute. But it's a minority of the component of EEM. China is like 30%. And went long EEM and shorted the exact same amount unleveraged of the S&P 500. I bet you'd make a ton of money on being global market neutral because the spread would widen, favoring
Yeah.
emerging markets. They would recoup in value, probably in net price as well. Not just that the S&P would go down, but emerging markets probably wouldn't just hold their own. They would probably go up. I don't think they have the government crisis and debts that we have right now, where suddenly we're at the forefront. Europe's at the forefront. England's at the forefront. Japan. Okay. I think they would win by default. One, they're underpriced. They're happy where they are. They're not excessive. So it's a trade. If you want to do it, I bet you make good money.
Okay.
Global market neutral.
All right. Okay. And what do you feel? Here's India. This is the Nifty futures, just shy of 25K right
Yeah.
now. What do you see
Well,
on?
we watched the Sensex, but that doesn't matter. Similar story.
Okay.
This is another market that is among the emerging, but is a bubble market.
Okay.
I mean, you can see, go back to 2009 and look where you are now.
Yeah.
Okay. It's definitely a huge multiple thing. Now, it has not made a new high, but still it's a bubble situation.
Yeah.
Momentum, long-term momentum of the Sensex, which is similar to this, is broken. Was that break we had from late last year into early this year broke the backbone of the integrity of the long-term momentum trend of this market. The current rally, whether it made a new high or didn't, in this case didn't, is a failing looking rally on momentum. Now, right now, the Sensex, I'm going to quote it because I don't do the Nifty. The Sensex is 81,500 right now. Okay. Now, if you drop down next month or after that, down to about 78,000, I would run screaming from the room. Okay. Because it's going to resume what momentum says it's going to do. In other words, it's going to head down. And probably with the Sensex, with the Nifty here, it'd be the similar thing. Don't go back through that recent low
Okay.
in the next month or two. Not that low, the low we just made. Yeah.
Oh,
Right.
this one.
Yeah. Yeah. In other words, you go back much below there and you're going to take out that other low.
Okay.
And
Okay.
also go back further on the price like you were a minute ago.
Mm-hmm.
You'll see look at the shelf there of lows.
Yeah. Right
Yeah,
here.
you see, it's what we call idiot price chart buying.
Yeah. Okay.
Somebody took a price chart and said, I'm gonna buy that low. Okay, well, it worked. Okay.
Okay.
If you ever go back and take that out, they'll run screaming
Okay.
because even their price chart will say, gee, I was wrong. Momentum says you're likely to be wrong. That low will not hold. And I wouldn't wait for it to even get back there. Again, the Sensex about 4 to 5% below where you are right now, you don't want to see again.
Okay. So you're saying like if it comes like this, don't get fooled into a double bottom. If
You
it
don't want
breaks
to drop
that,
back.
you're
You don't want to drop back about 4 or 5% below that recent low because if you do, you're on your way back down.
okay.
So anyway, so that is a component of EEM, by the way, and it is a bubble. So there is a bubble within the emerging markets. It's India, but fortunately, it's a minority percentage of EEM.
Okay.
China and related is a hefty percent.
Is a hefty percent. Okay. Okay. There you go, Mr. King. And one last thing. What have you taken a look at uranium lately?
Yeah, you can punch it up if you want.
You want URA, you want URNM, what do you want?
Get me the uranium itself if you can.
The spot price of uranium?
Yeah, the UXII there, that one.
Okay, this one. Oh, you know what? This got messed up for some reason on TradingView, and they haven't fixed it yet.
Oh,
I don't.
Okay, don't do that then. But what it did, uranium in 2018, 19, we got bullish. Uranium then was coming up to 20 something.
Okay. Here's
URA.
Yeah,
well, uranium went up and made new highs, got up to 100 area,
Yeah.
In summer of last year, it dropped back down to $85 on uranium futures, uranium 308 futures. And we thought, you're going to have a correction now. We're already $15 off the high or so. We thought it would go down to the 3-year average on uranium, which is in the 70 area this year. Got down to about 67, 68. But since then, we've oscillated either side of the 3-year average, comatose, just steady.
Yeah.
I think the sell-off in uranium is over. The question, though, is when will it resume the upside? I don't have a firm opinion on that. I do think long-term it's fine. This pullback is one to buy into, but I don't have a sense that you're going to get rewarded right away. Maybe it will. When you looked at your URA, though, it says, hey, we're ready to go for more.
Yeah.
They're back up to the highs again.
Yeah.
It was like those copper stocks versus copper. So even though you had a break in that your URA down and wiped out some lows there, you immediately exploded back up to make new highs, unlike uranium itself.
Yeah.
So at this point, I would, My view is that I don't think I'd buy them right now. I think I'd wait to see uranium actually show some technical evidence that it really is turning up out of this base. At that point, I'd say, okay, now commit to URA again. Because if
Okay.
uranium dawdles around for another 2, 3 months, URA is likely to pull back maybe to that prior high, for example.
Yeah, like down here to 34,
Yeah,
I guess.
34 area. So, but yeah, I think long term it's good. But the near term, the intermediate term, next few months, I'm not sure.
Okay. That's about how I was thinking of it, and then on top of that, like you, I feel like the S&P is at best going sideways from here, you know what I mean? And
Yeah,
generally speaking, these uranium equities seem to follow the S&P a lot more than like the other
yeah, that's
commodities that we
it's a
follow.
good point to be made. Yeah.
Yeah.
I think there's this is my big story, Bitcoin.
Ah,
Can you punch up a Bitcoin futures chart?
there we go.
Okay. You can broaden it out. You can just go back to, let's say, 2021, 2020. Yeah, that last high there at 70. Yeah, right there. That's good. Okay.
Okay.
Now, what do you got here? Monthlies or weeklies? This is
This is weekly.
weekly. Okay. Or yeah. Can you do a monthly?
Monthly, click. There you go.
Okay,
That's
now
from the
widen it
beginning
back
of
out.
time back here,
Yeah,
2011
don't
to
do that. You go back to right there. Start there.
right here,
When I got up into this 50s, 70s for the first time back in 2021. Okay.
2021, right here. Okay.
Yeah, okay. Okay, there you go. Now,
There we go.
you'll notice there's kosher type shelving action. You'll see the high there and then the high in late 2021, both up around, what, the mid 60,000 level or something like that, up to or
Yeah,
near
yeah.
the okay. And then you'll notice a couple years later, we got bullish, by the way, when it came up through 20,000 back in 2023,
Oh,
based on quarterly momentum. Then you surged up and nipped out that prior high
yeah,
right there, but about roughly the same level. So you had sellers up there still in
yeah,
that same general area saying, hey, I want out, I want out. And they created a quiet zone of distribution. It didn't collapse or anything. It
yeah,
was like a wasted time. They had 6 months of wasted selling. They really didn't go anywhere on the downside. Then you burst through. Now look where the low occurred back in April, right on top of that high.
yeah,
Okay, and they bought the old high. They bought on top of the prior distribution zone.
yeah,
Okay, now if you look at late last year, we got up there to 110,000 just about. Yeah, 110,000 late last year. That peak there, yeah.
yep,
Okay, and then if you go sideways, you'll see there's a couple months that also stalled right around the 110,000 zone.
mm-hmm.
So there were distributors there and distributors there. Now, if you overlaid, you can't do it here, but go back to like 2022 and overlaid this chart on top of the Nasdaq 100, they're twins,
Hmm.
almost month by month. In other words, Bitcoin is moving in an emotional, speculative way, just like Nasdaq 100 bubble is. The same flows in and out. It had a drop into April, Bitcoin, roared back up to the high, took
Yeah,
out the highs of late last year, just like the Nasdaq. And now what are you doing? Uh-oh, you're dropping back down toward those highs.
yeah,
You close a month out on Bitcoin. It's 113 something right now, back below 110,000. You get back below that distribution zone. It's
yeah,
saying, hey, this rocket launch is aborting. This is not like the prior ones where I
okay,
hold prior support. This
yeah,
time I'm going to abort back below prior resistance becomes support. Resistance becomes support. This time that resistance becoming support, if it doesn't work, you're in trouble. That's a price chart. Quarterly momentum of the Bitcoin is an exact overlay of the 1987 S&P chart
huh,
prior to the crash. You don't see it on price, but on momentum, it is precisely, you can overlay the quarterly momentum charts of both. What does it take to get Bitcoin price down to the point of breakage? This quarter, which is like 5, 6 weeks left, you get down into the mid 90,000, lower 90,000 zone. So down in the middle, yeah,
yeah,
halfway back to that low we made in the 70s. You get back there. Right about there, you break the quarterly. But when you get into next quarter, around 103 to 105,000, I'm going to blow the quarterly momentum structure that says you have a potential crash.
hmm.
Now, you ask about a stock market crash. I don't think that's going to occur. I think stock market's going to be more of a layered, arduous process. Bitcoin could be different. And again, it is an exact monthly bar chart overlay of the Nasdaq 100 since going back about 3 years, 2 to 3 years. Something's wrong here. It's not a stock market. Why is it behaving like the bubble end of the US stock market? What for? Is it simply because it's inhaling and exhaling with the emotional buying and selling that occurs in the Nasdaq? I begin to think it is. It's not behaving like a money unit. Okay.
Yeah.
It's behaving like the Nasdaq's twin. It has crash dimension technicals below it on momentum. And those numbers don't require that you come down and take out that last low at 70,000 area. They somewhere 103 to 105 next quarter, which is like 5-6 weeks away. I will do it.
Okay.
In which case you could get a 50% drop so fast you don't know what hits you.
Okay. Okay.
In other words, if you're gonna wipe out what we've just seen, you're gonna do it quickly. You're not going to do it slowly.
Yeah.
We're not at the trigger level, so don't confuse me. I'm not saying short it here. The first warning is getting back below 110
Okay.
on a monthly close. That's a price chart warning.
Okay.
Momentum will scream its head off if you get down next quarter, or if you're positioned at the end of this quarter to be in that 103 to 105 area. You'll inherit the trap door next quarter.
Okay.
This could be an ambush effect to the stock market because this market now, not 10 years ago, but now is so intertwined with major corporations that have committed, that aren't crypto companies, but are committed in big waves to either putting their money in it or being involved in it in some deep way, to where if this market breaks, it will actually have wave effects well beyond just Bitcoin traders.
Yeah, I've noticed that with this, that when I got into Bitcoin a long time ago, a lot of the reasons that I got into it are now just completely gone, you know, and okay, so basically what you're saying is like we've kind of had this momentum here where it's gone up above this price level and then corrected back to it, and then gone up and then corrected. And
Yeah,
you're
but all
saying
of a sudden, instead of surging big, you surged 1 month out of all that stuff. And now suddenly, what are you going to do? Give it back up the next month? You don't want to get back below 110,000 on a monthly close, probably even a weekly close. You don't want to get credibly back below that shelf because it says, hey, that was a breakout point. I'm aborting back below it.
Yeah.
And especially so quickly after having just had your breakout.
Yeah.
It's a bull trap, I think. But
Yeah.
it could become a major headline that is so essential now that it's not trivial. It's not just something, oh, who cares? It matters now.
Yeah. Okay. Awesome. Always a pleasure, Michael. Thank you very much. If viewers want to get a hold of you and follow your work, how can they do so?
OliverMSA.com.
OliverMSA.com.
We have sample reports there, and you can request current samples.
Awesome. We will put your links down in the show notes. Always a pleasure. Thank you very much for coming on the show.
Thanks, Steve.
And thank you for tuning in. Go to stevebartonmoney.com for more and have a wonderful day.